We live in a high-stakes world where billion-dollar companies are built, bought, and transformed, often behind closed doors, long before the headlines ever catch up. You've probably felt the sting of missed opportunities, or watched startups skyrocket and wondered why some explode into global giants, while others quietly fade into oblivion. The truth is, the biggest brands aren't just born from great ideas. They're forged through capital, money, risk, and bold strategy. Every major disruption, from the smartphone in your pocket to the platform you're watching this video on, is driven by a deep, deliberate understanding of how capital really works. Today, we're pulling back the curtain on the secret world of venture capital and private equity. You'll see how capital flows through every phase of a company's journey, from seed stage sparks to billion-dollar buyouts. Stay with me, because what you learn today might just be the missing piece that transforms how you understand business, finance, and your own future. Welcome to Value Runtime. I'm Young, a Wall Street veteran, Silicon Valley innovator, and Stanford-trained entrepreneur. Over the years, I've delivered value and created wealth across industries, from global internet companies to top financial institutions. Now, I'm channeling those insights into my own venture and sharing everything I've learned with you. In today's video, we're breaking down how venture capital and private equity shape today's biggest businesses. From the spark of early-stage venture funding to the strategic overhauls of private equity, we'll walk through the stages that build billion-dollar companies and show you the mechanics behind it all. Whether you're a curious learner, a future founder, or an investor looking for your next big play, this video will give you the strategic lens to decode how the business world really operates and how value is created, scaled, and captured. Let's start with a simple but powerful question. What is capital? In today's business world, you might hear about fierce rivalries, whether it's TikTok clashing with other short video platforms or Uber and Lyft competing in the ride-sharing arena. Behind these dramatic battles lies a hidden force: capital. At its core, capital is the money that fuels a company's growth and transforms innovative ideas into industry giants. It's provided by investors such as venture capital firms, private equity funds, or angel investors, who back promising ideas long before they become household names. Think of early-stage investors as the seed that helps a startup sprout. They invest when an idea is just a spark, trusting that with the right support, it can grow into something big. As companies develop, they typically progress through distinct stages. The early stage, where the idea is born, the growth stage, when the business begins scaling up, and the maturity stage, where it becomes a stable market leader. Private equity firms, names like Blackstone, KKR, and Hillhouse Capital, excel at investing in these private companies. They put money into a business, help it grow, and then sell their stake for a profit. Their strategy is essentially a buy low, sell high approach, but the methods and risks vary at each stage of a company's life cycle. Understanding these stages is key to unlocking how capital works its magic and drives market disruption. Next, we'll break down each phase and reveal how strategic investments evolve, from nurturing a startup's first steps to fine-tuning a mature enterprise for maximum growth and profit. Every empire starts with a spark, and in the business world, that spark is often an unproven idea with massive potential. Welcome to the early stage, also known as the venture capital stage. At this point, a startup is little more than a promising concept with the potential to change an industry, yet it remains untested in the real world. Entrepreneurs step forward with innovative ideas, whether a breakthrough technology or a creative twist on an existing trend, but they lack the market validation needed to secure traditional funding. This is where venture capitalists and angel investors come in. They're the risk takers to provide the seed money necessary to turn a raw idea into a tangible business. Their investments are typically modest at this stage, just enough to develop a prototype, open a first outlet, or launch initial operations, because the goal isn't immediate profit, but rather proving the concept. Investors here place a heavy emphasis on the founding team's ability to execute the idea, knowing that while many startups may not succeed, a few can deliver returns that far outweigh the risks. Consider an entrepreneur who spots a booming trend in bubble tea, while recognizing consumers' growing concerns about sugar intake. This visionary decides to create a zero-sugar, zero-fat, zero-calorie bubble tea. In the venture capital phase, the idea is still in its infancy, requiring early-stage funding to test the concept and capture customer interest. With the right backing, the startup can launch its first store, and if the market responds positively, pave the way for further growth. Think about it. Every iconic brand you know today once stood at this exact crossroad. They had no traction, no recognition, and no guarantees. Only a bold idea, and the need for capital to bring it to life. Take WhatsApp, for example. In its early days, it was just another messaging app trying to stand out in a crowded space. But it caught the attention of Sequoia Capital, which invested $8 million in its Series A round. That investment turned into over $3 billion when Facebook acquired WhatsApp for $19 billion. That's the power of early-stage capital backing the right team and vision. At its core, the early stage is all about nurturing a raw concept into a validated business model. Once the market shows its approval, the startup is ready to advance to the next phase, attracting larger investments that drive rapid expansion and set the stage for future success. The growth stage marks the transition from a promising idea to a scalable business. At this point, the initial product or service has proven itself in the marketplace, and the company is ready to expand. With positive market feedback in hand, entrepreneurs look to multiply their success by replicating and scaling operations, whether that means opening more locations, ramping up production, or entering new markets. In this phase, investors shift their focus from pure potential to proven performance. Growth equity investors step in with larger sums of capital, often ranging from several million to tens, or even hundreds of millions of dollars to fuel this expansion. Because the business already has tangible market traction and operational data, the investment risk is significantly reduced compared to the early venture capital stage. But it's not just about money. These investors also bring valuable strategic support, offering management expertise, extensive networks, and additional resources that help accelerate growth. Think of Series A, B, C, and D rounds as different rungs on a financial ladder. With each round, the company trades equity for more capital and more credibility. Investors at this stage don't just write checks. They open doors, offer strategic guidance, and help the company avoid growing pains that can derail momentum. Take Spotify as an example. After proving its model in Sweden, it needed capital to expand across Europe and eventually into the United States. Venture firms like North Zone and Excel helped fund this expansion, and their growth capital played a pivotal role in Spotify becoming a global streaming giant. In essence, the growth stage is all about execution. It's about turning a validated business model into a dominant force in its industry. Eventually, companies grow up. They become large, stable, and cash flow positive. Their brands are well known, their customer base is loyal, and their products are consistent. But that doesn't mean the journey ends here. In fact, it's just the beginning of a new chapter, a chapter of optimization, transformation, and value creation. This is where private equity takes center stage. Unlike venture capitalists who fund uncertainty, private equity firms invest in predictability. They buy into companies that have strong fundamentals, but often untapped potential. Their job is to amplify performance by improving operations, cutting inefficiencies, and making strategic moves that boost profitability. Imagine you're buying a beautiful old mansion. It's solid but outdated. A private equity firm comes in, renovates it, updates the systems, and then sells it at a premium. That's the business equivalent of what they do. Often they take a controlling stake. That means they influence or even replace management teams, introduce better accounting systems, and help the company modernize across every function from sales to supply chain to digital transformation. One famous example is the acquisition of Hilton Hotels by Blackstone. In 2007, Blackstone acquired Hilton for about $26 billion. Despite the timing right before the global financial crisis, Blackstone improved Hilton's operations, expanded globally, and took it public again in 2013. The IPO became one of the most successful private equity exits in history, earning Blackstone over $14 billion. If you're enjoying this video so far, please consider subscribing to Value Runtime and hitting the like button. Your support helps us reach more viewers and inspires us to keep delivering great content. One of the most powerful tools private equity firms use is the leveraged buyout, or LBO for short. Here's how it works. A private equity firm uses a mix of its own money and a large amount of borrowed funds to buy a controlling stake in a company. Think of it like buying a house with a mortgage. You put down a portion of your own money, finance the rest, and then work on increasing the property's value before selling it. The same principle applies in business. By improving operations and strengthening financial performance, the private equity firm aims to sell its stake at a significantly higher price, even after repaying the debt. Although leveraging increases financial risk, it also magnifies the potential reward. Moreover, firms like Blackstone, KKR, and Hillhouse Capital have earned reputations for driving value even in companies facing operational or financial difficulties. They achieve this not only by injecting capital, but also by implementing strategic changes that streamline operations, reduce costs, and open up new revenue streams. Over an investment period of 3 to 7 years, these firms work diligently to transform a company into a more efficient and profitable entity, paving the way for a lucrative exit, either through an initial public offering or by selling the company to another buyer. The professionals managing these investments are seasoned experts, often coming from rigorous backgrounds such as investment banking, where they honed their skills in high-pressure environments. Their deep understanding of finance, operations, and market trends is critical when navigating the complex challenges of restructuring a mature business. A prime example is Canada Goose. In 2013, Bain Capital acquired a 70% stake in the iconic brand, restructured its operations, expanded its market reach, and ultimately took the company public in 2017, generating impressive returns for its investors. Up to this point, we focused on how capital fuels growth. But here's a twist that most people miss. Not all investments are made for the same reason. There are two main types of capital plays: financial investments and strategic investments. And understanding the difference is key if you want to see the full picture. Financial investments are all about the numbers. Investors in this realm focus primarily on profit. They buy, restructure, and eventually sell companies for a handsome return. This classic buy low, sell high approach centers on financial gains and capital appreciation. In contrast, strategic investments go beyond mere numbers. Here, the investing company isn't solely chasing profits. It's seeking synergy and added value. For example, a large tech or retail firm might invest in a promising startup because the new venture complements its core business, much like a global e-commerce leader acquiring a logistics company to streamline its supply chain. In such cases, the investment isn't just about making money. It's about integrating operations, expanding capabilities, and creating a competitive advantage. Often, these two types of investments run side by side. Even well-known companies with huge cash reserves like Apple or Google sometimes pursue mergers and acquisitions that support their strategic goals, rather than focusing purely on financial returns. But not all strategic bets pay off. Take Google's $12.5 billion acquisition of Motorola Mobility. Despite strategic intent, the venture didn't yield strong long-term results and was later sold to Lenovo for a fraction of the purchase price. Now that we've explored the stages individually, let's zoom out and look at the full arc of how capital flows from idea to empire. In the very beginning, when a company is just an idea on paper, venture capital investors take the risk on unproven concepts. Once the idea is validated, growth stage investors step in to help scale the business by infusing larger sums of capital, along with valuable experience, resources, and industry connections. Finally, as the company matures into a stable enterprise, private equity firms fine-tune operations and boost profitability, often using leveraged buyouts to maximize returns. This process is a dynamic, ongoing cycle. Early investors exit when the company reaches a certain valuation, typically selling their stakes during subsequent funding rounds. Each round not only increases the company's worth, but also signals to the market that the business model is robust and promising. At this point, it's useful to introduce two key terms in the private equity world: general partner and limited partner. General partners, essentially the fund managers, steer the fund's decisions. Limited partners, essentially investors, provide the capital. A common arrangement is the 2-and-20 rule, where investors first pay a 2% management fee, and the profits are split, 20% to the general partners and 80% to the limited partners. As the cycle continues, some companies eventually go public through an IPO. Take Uber, for instance, which went public after several rounds of funding propelled its valuation to new heights. Others remain private for extended periods, continuously raising capital to fuel their growth. Consider SpaceX, which has raised billions in funding and remains privately held, commanding one of the highest valuations among private companies. This entire cycle, driven by both financial and strategic investments, is what fuels innovation and growth in the global economy, underscoring why a deep understanding of capital is crucial for anyone interested in entrepreneurship, technology, personal finance, or investment strategies. So, what have we learned? Capital isn't just money, it's the engine of transformation. From the daring bets made by early-stage venture capitalists to the strategic maneuvers of mature private equity firms, every step in the investment journey plays a pivotal role in building lasting value. Whether you're an aspiring entrepreneur, an investor with a keen eye for opportunity, or simply someone curious about how the global economy ticks, understanding the interplay between capital and innovation is essential. As you move forward in your business or investment journey, I encourage you to look beyond the numbers and appreciate the broader strategy that drives success. The stories behind these investments are as compelling as they are instructive, revealing lessons in risk, timing, and the power of a well-executed vision. If you found this video helpful, please hit that subscribe button, give us a like, and share your thoughts in the comments. Your engagement drives us to keep finding new ways to create value in a fast-changing world. For deeper insights and helpful resources, please check out valueruntime.com. I'm Young at Value Runtime. Thanks for watching, and I'll see you in the next video.